if there is no interest in a particular project, or there's no utility in that project, or the market deems that project to be useless, there's really not much that a market maker can do to kind of revive that project. We can only do what we can do, and that's to provide the service that we, are in contract for.
Hi, everyone. Welcome to Unchained, your no-hype resource for all things crypto. I'm your host, Laura Shin, author of The Cryptopians. I started covering crypto 9 years ago, and as a senior editor at Forbes, was the first mainstream media reporter to cover cryptocurrency full-time. This is the August 20th, 2024 episode of Unchained. Get ready for the world's largest crypto event, Token 2049 Singapore, September 18th to 19th. Balaji Srinivasan, Richard Tang, Arthur Hayes, and 300 others will hit the stage, joining 20,000 attendees. Visit token2049.com for 15% off with the code UNCHAINED. Link in the description. Mantle's METH is now the fourth largest LST with $1.3 billion in TVL. METH offers holders cumulative incentives and airdrops, in addition to native ETH POS yields. This includes exclusive rewards like Eigen and Cook. Check it out at meth.mantle.xyz/campaigns. Polkadot is the original and leading Layer 0 blockchain with over 2,000 plus developers. And the Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem, making it faster, more secure, and adaptable. Perfect for GameFi and DeFi to build, grow, and scale. Join the community at polkadot.network/ecosystem/community. Today's guests are Reid Werbitt, US CEO of Flowdesk, and Hanson Birringer, head of US Sales at Flowdesk. Welcome, Reid and Hanson.
Thanks, Laura.
Hey, happy to be here.
So this year, we've seen more new tokens that have been listed on digital asset exchanges in the first half of this year than in all of 2023. And I know this is sort of squarely in your line of business. So why don't we just start with your background, and we can kind of get into all the details on this area of the market. So Reid, why don't you start?
No problem. So I spent the majority of my career in TradFi, working for some large hedge funds, Millennium Partners in particular, always on the trading side. I was interested in crypto in 2016, 2017. I went full-time into crypto in 2018 when I joined Genesis, and I started there running the APAC trading desk. I left Genesis in 2022 as managing director and head of global spot trading. I joined Flowdesk about a year ago as US CEO to build out the team here and really focusing on our US and global expansion as it pertains to the market making and OTC side of the business.
All right. And Hanson?
Hey, so similar, background as Reid. Started my career here in New York in the traditional finance banking sector, and then left that after a 2-year stint to join Genesis on the institutional sales team, which is where I was for 3 years, and then recently joined Flowdesk this past year to, again, help build out our U.S. franchise, specifically on the market making and OTC side of the business.
Okay, so now let's talk about Flowdesk. What is it? Why did you decide to launch it? What problems or issues in the industry were you trying to solve?
Yeah, so Flowdesk was actually founded in 2020, so we have been around for a while. Relatively under the radar, and we are a regulated, licensed, full-service digital asset trading technology firm. So we have 125-ish globally. We're headquartered in Paris, and we have offices in Singapore, the UK, the US, and Canada. And as I mentioned earlier, we focus on market making, OTC, high-frequency trading, venture, as it relates to our core businesses. And we have trading relationships with exchanges, token issuers, asset managers, hedge funds, VCs, ultra high net worth, early adopters. The list kind of goes on and on. Systematic market making is in our DNA. There were very obvious synergies and crossover to me as I joined about a year ago as it relates to principal bilateral OTC trading. And with connectivity to over 140 exchanges, I think now, it just made a lot of sense, both on the spot, derivatives, and credit side. So I would say our mission is to put forth innovative products and optionality for our clients on both the market making side and the OTC side, with a focus on trust and transparency and best practices in pricing and execution.
Well, so 2020 was obviously a really different time in the crypto markets. So what were some of the issues in the markets that you saw at that time that you felt that Flowdesk could make more efficient?
So to be clear, I joined Flowdesk in September of last year. I've been in crypto since 2018. The market structure has certainly evolved over time. That's been a product of the macro environment, the regulatory environment, political environment, which we're certainly seeing a lot of now. But I would say, generally speaking, as adoption continues to increase and more institutional players come into the space, there is always a need for sophisticated counterparts and OTC and liquidity providers to facilitate their business. And it kind of ranges from, all the way from market making to block trading, programmatic trading, high touch credit structures, et cetera.
Okay. Now, why don't we just sort of talk about some of the core functionality that you're offering here? Let's start with market making. Why don't you describe exactly what market making is and why we need liquidity providers?
Yeah, so I'll let Hanson kind of dive into this a bit more, but essentially, as a market maker, we facilitate and provide liquidity for both token issuers and exchanges. And typically, a token issuer will provide capital to us, which we algorithmically and systematically manage the order book for. This can be as simple as one pair on one exchange, or it can be as complex as multiple pairs across multiple exchanges. It really depends on the client or the token issuer.
Yeah, and I think just to expand upon that a little bit, the history of Flowdesk, we originally started out doing this more retainer-based approach to market making, where the client themselves, whether it be the token project or the exchange, is providing the capital, and Flowdesk is bringing our proprietary trading infrastructure to the equation and managing that on their behalf. And how we were compensated was with a monthly retainer fee. Over time, as well as our firm has evolved and our balance sheet has gotten bigger, we have also done more principal-based market making or liquidity provisioning packages with clients, which is when we are bringing our balance sheet to the equation. Typically, how this looks like in a token project deal is the project themselves is lending us some supply of their token, and then we are bringing our cash balance sheet and using those two sides of the formula to market make on the various DEXs or SEXs that they are currently trading on live.
Okay. And so how do you typically start working with a token issuer? Because there's so many different ones out there. So what is your own process for deciding to work with one, and then what happens once you decide to work together?
Yeah, I can take this one, Reed. So I would say the typical life cycle of one of our token project clients typically starts out with either an introduction from a venture capital firm that they're a portfolio company of, which we have a relationship with, and or a sales prospecting, word of mouth in the industry. We're a regulated, compliant market maker, so a lot of very good projects like to work with a trusted counterpart that is transparent and has a good pulse on the market, introductions to exchanges, etc. I would say the typical questions we ask these projects is really threefold. Is when are you going to launch? Market structure and environment and sentiment plays a big factor in their strategy of going to market with their token. 2, where do you want to launch? So are you doing a centralized exchange, a decentralized exchange, a combination of both? Are you doing a centralized exchange token launchpad? And then 3 is how do you want to engage with the market maker? Kind of going back to what I just spoke about, whether that's a loan call option structure or more retainer-based approach.
And because there are so many potential tokens that are coming onto the market, like how do you also vet, or is it just like because you're being introduced by a trusted entity? Is it simply that, or?
There's definitely some qualifications that we look for as well. Given we are a regulated firm, we have to, we perform KYC and AML due diligence on everyone that we work with. And so, a typical starting point is the token project has to have an entity. We KYC all the team behind it. Also, as we know, the market structure of bigger projects this cycle has really transformed into meme coins. We work with a couple of the larger projects. We also work with a bit more, I would say, traditional crypto projects, right, in DeFi, lending platforms, perpetual DEXs that have governance tokens, things of that nature. So for us, we work with a wide spectrum of clients, I would say. But the typical qualifications to work with a firm such as Flowdesk is, a certain amount of market cap. We want to make sure that we are actually adding value to you as a project in your journey. But with that in mind, we do work with projects right from 10 million market cap to 10 billion. And we like to support them in those early stages so that we can be their trusted counterpart for many years to come.
And then from their side, when they're choosing different market makers, like what are the kind of factors that they're using to make that decision, and what are you offering as a differentiator?
Yeah, so if I was to put myself in their seat, what I would be looking for in a market maker is one, who am I doing business with? Are they a regulated counterparty or not? Two, are they a well-capitalized counterparty or not? Three, do they have the exchange connectivity that I need for my token? And I think, Flowdesk, we check all three of those boxes. We're a regulated digital asset service provider by the AMF in Paris. We've raised over 9 figures of venture funding. And 3, we have access to about 140 different exchanges that we work with, both centralized and decentralized. So those 3 things is what I would be looking for in a project or in a market maker as a project. I think that's how we've been able to grow our business so successfully on a global scale.
So what is the volume that you are typically handling in a given month?
Yeah, so we don't typically disclose precise volume numbers, but we're trading billions of dollars a month in volume.
Okay. And so now walk us through that, kind of strategy that you talked about, where it was like, do you launch into decentralized exchange or a centralized exchange? Like which markets, just like talk about what would make a token issuer decide one or the other, both for decentralized, centralized, and then geographics and the other factors.
Yeah, so what I've seen in conversations with projects, it definitely varies by region, right? So we have offices kind of east and west markets. We work with projects a bit differently. I would also say if they were a venture funded project or just kind of a more, grassroots DAO, community funded, meme coin, if you will, their balance sheet as an entity looks very different. Typically, the venture funded clients have cash as well as their token on their balance sheet versus these more grassroots tokens are very token rich, cash poor, for better or for worse. And so the type of structure and engagement with the market maker will look very different depending on their own balance sheet composition of assets that they can utilize for hiring and engaging with the market maker.
Okay. Well, but out of curiosity, like I feel like there's another piece of it which I am very interested in, which is this geographical difference across the world, I guess. What would you say are some of the characteristics of tokens that are choosing to launch, sort of like in a Western type of market versus an Eastern type of market?
Yeah, that's a great question. And I think also it's a bit nuanced because while we do see some of these entities domiciled, offshore or internationally, a lot of the team might actually be, in the West versus the entities out in the East, or they are part of the team half and half. Crypto is a very global industry, as we all know, which is a great thing. So it's really hard to pick a very specific type of project that will launch in this region versus this other region, just because we are such a global industry and, all of the cultures and different types of market narratives tend to bleed together over time.
Oh, but you don't notice kind of any trends either way?
If I had to, just think of some high level narratives industry wise, we definitely see the gaming sector very prevalent over in Asia. And I think we see a bit more capital markets, DeFi like lending protocols, DEXs being built here in the West. Not to say that those types of teams don't exist in other parts of the world, but I would say holistically speaking, those two trends are fairly dominant in those two areas.
All right, so obviously in recent years we have seen that there have been some controversies with different market makers. Very obviously, there's the Alameda situation. There are multiple teams who sort of felt that through this investment that they were going to get the support, and instead they found that upon launch, the way Alameda handled it caused the price of their token to crash, and it sort of made it kind of really difficult for their project to get off the ground. We also saw these allegations that Jump helped Terraform Labs manipulate the price of UST. And so I wondered, just like given kind of this history, Do you have advice for token teams for when it is that they are choosing a market maker?
Yeah, I would say, all the reasons that you just outlined is why Flowdesk was created, to address those problems in the market making part of the crypto industry. Where our motto is bringing transparency and trust to crypto markets. And the really inception of the firm was this retainer model where clients get a 24/7 dashboard with full insight and data and analytics and reporting tools, down to the tick data of how we as a market maker are utilizing their funds in a market making strategy, which they also have insight and control over and can help dictate the strategy with our team's obviously advice and guidance of what we're seeing day to day. And I think this also ties back to what I was speaking about before. Those three things that I would, behoove products to look into is, are you facing a regulated counterpart? Or is this just an entity on some island offshore with a website that has trading algorithms built out and a good marketing team or Twitter presence? And then I would also, another good kind of check the box thing is, do they have a bank account, or can they only settle in stable coins and crypto? It's just another very simple thing to ask a firm that you want to do business with, to see if they've been vetted by some other financial institution in the real world. And so all these things to say is, unfortunately, there are bad actors in the crypto space, specifically in the market making side of it, and that is really what Flowdesk was created to address and hopefully solve long term.
And so then when the token issuers are deciding where to launch in terms of exchanges, like what should they be looking for when it comes to an exchange?
This one is definitely a very popular question we get. I think it's a lot to do with the token project strategy. There's obviously certain exchanges which charge more for listings versus some that charge less. There's certain exchanges which are primarily focused on a certain sector geographically of like retail users. Coinbase kind of being predominantly North America, Binance, Werbitt, OKX predominantly being the APAC regions of the world, and Europe. And so you really have to understand who your underlying target market is as a project of who you are going to be getting access to when you get listed on this exchange, and playing that into your broader strategy when you're going to market with your community in mind.
Yeah, I think in addition to that, I think optics are considered. I think volume is considered and liquidity is considered. There are multiple tiers of exchanges. And a lot of times these projects, maybe their North Star is to get a Binance or OKX listing, but that might not be possible. So it's kind of going down the ladder of optionality that they can list their tokens. But ultimately, I think that all token issuers are trying to construct the strongest messaging to the market. And the listing process is certainly a big part of that.
And so when you say Binance and OKX are kind of more competitive, like, what are the exact features that people are interested in there? Is it simply volume, or like, how is it that people are sort of having this mental ranking of like which are more desirable than others?
Yeah, I think it comes down to, there's a branding exercise here. I think Binance and OKX have done a very good job in sort of their optics and their presentation to the marketplace. And I think as such, you see volume follow that, listings follow that, and volume begets volume in a lot of cases. And I think ultimately you want to be where the liquidity is. And usually those are the top tier exchanges that we've mentioned.
And then have the launch of the Bitcoin and Ether ETFs changed that at all? I know it's only for those two coins, but because those are the most widely traded coins, I didn't know if that also affected even like how new token issuers were thinking about the exchanges.
Yeah, so Coinbase has obviously been the big winner with the ETF launches. I think that net, it's positive across the board for all of the top tier exchanges. But I think at the end of the day, from a ETF perspective, as a market maker, we look to other exchanges to hedge and offset our risk. That is a exercise that can be done across a wide array of exchanges, not just Coinbase. So I think, it's been good for the industry at large, but I think that the real beneficiary of the ETF launches has really been more Coinbase than anybody else.
Okay, so for these new token launches, because it is so competitive and apparently is becoming even more competitive with as we said early on, more tokens launching in the first half of this year than in all of 2023. What would you say are kind of like the characteristics of an ideal token launch? Like, what are kind of the main points that these teams are trying to hit?
I think to really drill into the answer to this question, we have to categorize the type of token launching, right? We've seen the emergence of launchpads like Pump.fun, which anyone can create a token in a couple clicks of a button, and you have an instant access to a funnel of users who are trading all these very low market cap coins. You then have a bit more what I would call like institutional grade projects, which have a proper VC funding round, angel rounds in the space. Maybe some of the exchange VC funds are also investing in them for a pipeline to get listed. So it's a very different type of category of a launch. And so I think the qualifications of what those two different types of projects should be looking for is very different. I can't really give a hard answer on what the best route is. I think it really depends on what type of project you're looking to build, and type of community you're looking to attract to your coin.
Yeah, but I mean, you could, if you want to give the characteristics for each of the two.
Yeah, I think on the community meme coin side, right, we're seeing a lot of traction in things that people think are funny, they're enjoyable, they have a fun message around it. They're obviously building and appealing to a large variety of investors or just market participants. And then they're looking to, those coins typically stay on the decentralized exchanges, and then they eventually get onto some of these lower tier exchanges like Reed was mentioning, with the goal ultimately to being listed on the Binances of the world. On the flip side, you have these more institutional projects that have a real team behind them. They've been building for a year or two. They're kind of very strategically planning their go-to-market strategy around maybe potential other L1 ecosystem launches. Right? We have Monad coming out in Q3, Q4 this year. Potentially, there's a lot of projects that are waiting because they're launching on that chain. So just a very different type of strategy of when they're going to market with their TGE.
And how have airdrops and points changed that calculus?
Points have been an interesting narrative, I would say, that the market really caught on to during the bear market when I think projects didn't have capital to reward users, but they needed to incentivize liquidity somehow. It's really got this grasp now on the industry of a way to attract either TVL or users or reoccurring activity on your platform in anticipation of a future airdrop potentially. So I would say points are here to stay. Whether they evolve to be something different than what they currently are today is yet to be determined. However, I do see that trend continuing of there's a lot of liquidity in crypto that's very fragmented. And we kind of say here, on the desk, there's this hot ball of money that likes to rotate around different narratives in the space. So really capturing and holding the mind share of liquidity in the market is very important for projects today.
Well, I mean, we've seen that multiple times after an airdrop. Then, so I should let people know this is coming out August 20th, but we are recording on the last day in July. And this is because I have a vacation coming up. So we're planning all these in advance. But the week that we're recording, we saw that, I can't even remember the exact Starkware project it was. Was it Starknet that closed? And so, but the point is, this was kind of shocking. I guess this was, just something where this chain kind of just died. Like the activity just wasn't there where they could keep going. So yeah, if the way that, you are involved as a market maker, if that can, help a project like that.
Yeah. So I think you're referring to ZKX, right? The derivatives exchange.
Yes.
So I think that is a case which we've seen, happen as what you're alluding to, right? As soon as the incentives dry up, capital rotates elsewhere and users change whichever product they're using, which is, the beauty of a free market. But also, sometimes if you don't have, let's say, the best product in the market, users are free to leave and go elsewhere. And so we saw that, in DeFi summer a couple of years ago when these new projects were coming out and just incentivizing users with their token on a streaming basis or vesting basis. And now it's kind of rotated to points or a combination of both. And so I think this trend will continue as long as there are still new projects and forks popping up in the industry, as they have really no other way to attract users unless they have a superior product. So the real winner in this space will have A good product, and B, a good user retention program, whether that be through token incentives and or points that can be utilized in some shape or fashion on the platform itself.
I think, Laura, it's also important to kind of highlight what a market maker does or what they're supposed to be doing, right? And at the end of the day, it's our job to be posting liquidity and kind of actively managing the order book, both sides of the order book. So the goal is that we facilitate a more orderly market. We tighten the spreads. In theory, we should smooth volatility. And ultimately, this is better for the token issuer. But most importantly, it's better for the end user, which is the buyer or the seller, right? So if there is no interest in a particular project, or there's no utility in that project, or the market deems that project to be useless, there's really not much that a market maker can do to kind of revive that project. We can only do what we can do, and that's to provide the service that we, are in contract for.
Right. Yeah, that makes sense. And earlier when we were talking about, when you are making a deal with a potential token issuer, obviously we have seen that there's a lot of controversy around these high, fully diluted value, low float coins. So I wondered, is that also a factor that you're looking at? Just like, what is the distribution of this token?
Absolutely. And that plays a much bigger part of the initial, I would say, economic conversations when we are engaging with the project. If we are going with a loan call option route, which typically would have, a couple strike prices of the call option embedded to that loan. And so when we take into account there the calculus of the FTV of the project, which those strike prices are going to be pegged to. And so, we look at past data, past funding rounds, anticipation of TGE valuation. All of those things play a large part in how we determine the feasibility of engaging with the project as well.
Oh, interesting. And are there certain thresholds where you feel like, the distribution is such that it's unfavorable, not even just to your business, but as we were talking about, for the health of the token and for its ability to gain adoption in a community?
I think the trend we've seen is a lot of the larger launches this cycle have actually been the deals that were struck during the bear market. And so these vesting schedules look very different than I think projects raising today are able to, negotiate with their investors. And so that's also another thing to note too, is we're seeing a lot of projects who have these old, bear market legacy market making contracts come to expiry and looking to now re-engage the market, speak with new market participants. And those sort of deals look very different than they did in 2022, 2023 even. And so, the FDV and market cap of the token is certainly a big factor in those conversations when you are engaging in this loan call option route.
And when you say that they look very different, what does it mean? Does it mean that they look less favorable to community members and more favorable to the token teams and their investors, or?
I would say a bit, actually the opposite. The because of the market structure right now, the token issuers themselves have I would say a lot more bargaining chips to use.
That's what I mean.
Yeah, when they're engaging with the market maker. So because it is a bull market, there's a lot of firms out there to work with for a token's perspective. And so, when we are competing in deals, some of these larger launches can be quite competitive, which is good for the project because they should be getting a very competitive bid on the street.
Oh, okay. But I guess what I'm asking is, does that mean then that, I'm sure because of this sort of tension between what we're talking about, like a community coin versus like a VC coin, does this create a condition where the distribution is less favorable to the community?
I don't think so. I think if anything, if the team is able to have better bargaining power, which I believe they do in this current market cycle, that should be a good thing at the end of the day for the community, because the project will be retaining more of the token supply, as well as having typically like further out of the money call options on these strikes.
Okay. But I guess then that would mean that allows them to go more in the direction of doing a low float and having a high FTV, which is what people are sort of objecting to.
Oh, sorry. I might have misunderstood your question. Yeah, so I think projects are realizing today that it's better to have a higher float on TGE. I think you want to get more of the supply out to the community. I think when you have these projects launching with 1-2% of supply and then 98% of the tokens locked, you have these vastly wild price fluctuations. And in my opinion, it's always better, this is crypto, to get it out more to your community and have a better diverse holder count and investor base versus having 95% of the tokens vesting in venture capital investment deals.
Oh, okay. But since they have the upper hand, they are pushing to have more of a higher percentage circulating supply. Is that what you're saying, or?
I would say, yeah, it's really up to the project. The market maker, we're not dictating their vesting schedule, but I will say that in our conversations with projects that are now raising money, they are typically doing or steering towards more higher initial supply on launch to use for airdrops to the community or things of that nature.
Okay. All right. So in a moment, we're going to talk about some of the other parts of Flowdesk business, but first, a quick word from the sponsors who make this show possible. Join 20,000 attendees for the world's largest crypto event, Token 2049 Singapore, September 18th to 19th. Anatoly from Solana, Kyle Samani, Ahmad Mostak, and 300 others will hit the stage for an immersive festival experience ahead of the Formula One Grand Prix weekend. Singapore will transform into a buzzing crypto hub from September 16th to 22nd, with over 500 side events taking over the city. This is an event you've never seen before, with paddle courts to rock climbing monoliths and mixed martial arts shows as the global crypto community takes over the iconic Marina Bay Sands to spark connections and define the future. Visit token2049.com for 15% off tickets with the code Unchained. Link in the description. Mantle LSP is a permissionless and non-custodial Ether liquid staking protocol deployed on Ethereum and governed by Mantle. METH serves as the value accumulating receipt token of Mantle LSP and is now the fourth largest ETH LST with $1.3 billion in TVL. In addition to native ETH POS staking yields, METH holders can access various yield opportunities across dApps on Mantle Network L2 integrations and more. METH holders have previously received over 1 million in Eigen token airdrops. With the upcoming October 2024 launch of Cook, the new governance token of Mantle LSP, METH holders can start accruing powder rewards under Season 1, Metamorphosis, which will be convertible to Cook. Visit meth.mantle.xyz/campaigns to learn more. Polkadot is the original and largest Layer 0 blockchain with over 2,000 plus developers. And the anticipated Polkadot 2.0 upgrade will be a massive accelerator for the ecosystem, upgrading the infrastructure with 8 times higher transaction throughput and twice as fast block times, perfectly tailored core time for the needs of every protocol, trustless bridges internally and into Ethereum, Cosmos, Near, Binance Smart Chain, and revised tokenomics and the implementation of a token burn to reduce inflation. Perfect for GameFi and DeFi to build, grow, and scale with one of the most active crypto communities in the space. Polkadot recently announced a partnership with Mythical Games, bringing top games like NFT Rivals with over 650,000 players and 43 million transactions to pave the way for GameFi and the Polkadot ecosystem. Get your Web3 ideas to market fast with economics that work for you. Think big, build bigger with Polkadot. Join the community at polkadot.network/ecosystem/community. Back to my conversation with Reed and Hanson. So we've been talking about the market making part of business, but obviously you also offer OTC, over-the-counter trading. So just to level set for listeners who don't know, what is over-the-counter trading?
Yeah, so I think it's important to kind of note the difference between market making and OTC. And I think ultimately it's that it has a different clientele. As mentioned before and previously, I think the market making product is needed by token issuers and exchanges for a variety of reasons that we've discussed. OTC trading services or bilateral OTC trading caters more to the institutional side of the business, whether that's asset managers, hedge funds, protocol treasuries, miners, venture funds, early adopters, ultra high net worth, etc. So that's who I would say we kind of target with the OTC service. And, at the end of the day, we are providing principal balance sheet to facilitate that liquidity and provide our clientele with risk pricing on whatever it is that they are looking to express or hedge or reduce risk, etc.
And so typically, like, how does that kind of trade occur? Like what are all the different reasons why someone would turn to you rather than just doing a transaction on an exchange?
Yeah, I mean, I think that there's a lot of reasons why OTC desks benefit the end user. I think we offer tighter spreads. I think that we provide a scenario that that warrants less market impact. I think there's a component of anonymity. I think we can offer complex algorithmic strategies that they won't be able to do or execute just via DEX or a SEX. Certainly liquidity access to exchanges that they might not have access to. I think there's a risk management component to it as well. You know, the client doesn't need to manage inventory in a bunch of different exchanges when they can just go to one point of contact in an OTC desk and have a trusted partner there. So I think there's a lot of reasons why the institutional side of the house favors the OTC model. And, you know, we're pretty excited about, you know, what we've built over the past, call it, year as it relates to that.
And so because you are, you know, trading in, you know, these large size transactions, what are some trends that you've been noticing in the markets? Especially, I would imagine they've changed quite a lot this past year, not just because of the ETFs, but it just feels like, I mean, there's so many different factors here. It's like this proliferation of the meme coins. It also feels like there's sort of different narratives going around, you know, whereas before it was like a lot more simple with kind of like Bitcoin and Ether. And now sometimes, yeah, it feels like there's just so many other types of directions that things could go. So what are some trends that you've been noticing?
Yeah, I mean, I think we've seen a general maturation in the market. Certainly, if you're looking year over year, I mean, Bitcoin, I think, was sub 30K last August, and, you know, we're at roughly 66 right now. So I think with that comes quite a bit of sort of increased, you know, not only development, but also requirements from our counterparty base. You know, I think that our clients consider whether or not they want to trade principally or via an agency model. I think that licensure is a big consideration. I think balance sheet is certainly in the forefront of everybody's mind. Liquidity access, even basic things like responsiveness and professionalism, I think are very important and sometimes overlooked. So we really strive to put forth our best efforts there. Operational workflow is a huge thing too, right? I mean, in crypto, I think a huge component of the client experience lies with the operational workflow, with settlement, with banking rails, with custody, et cetera. So I think all these things are becoming more and more clear to the institutional market, if you want to call it that. And that's really what we've been focusing on here.
You know, obviously, I know that you have your own OTC desk, but when you look at kind of the different possibilities for these different, you know, entities who use OTC services, like what are the different factors that they might think about when they're choosing the right OTC desk?
Yeah, I mean, as I mentioned earlier, I think it's a combination of a bunch of things. And I think the principal model versus agency model is a big consideration. I think that licensure and balance sheet are big considerations. I think that communication channels and, you know, settlement process are big considerations. Technology is certainly something in the forefront of everybody's mind, what we're capable of, what we can do, how we can access that liquidity, reporting, internal tools that can be sort of used to improve the experience of the client. So I think that there are some major touch points and sort of considerations that all of our clients kind of go through. And we try and keep that, you know, in the forefront of our product as we roll that out to the market.
And what are the differences between crypto OTC and TradFi OTC?
I think there's a lot of similarity, to be honest. You know, I think TradFi has a tendency to be more of an agency model. You know, they certainly do trade principally. They certainly do facilitate block trading with their own balance sheet. That's more or less how we run our business here. There are other OTC desks that operate on an agency basis. We do not do that. We utilize our own balance sheet and we, you know, warehouse and hedge risk accordingly. I think, you know, there are some big differences between crypto OTC and TradFi OTC. And I think that revolves mostly around the settlement process and clearinghouses, what folks are used to, with the TradFi DTCC, we don't have that in crypto, right? There's no centralized clearing agency yet. I think that once we crack that,
I don't think that's going to happen.
Yeah, listen, I think regulatory clarity and likely some sort of, GSIFs entry into the market will certainly change that.
And so GSIF is?
It's a global systemically important financial institution.
Yeah. Right.
So think like JP Morgan, right? Or Goldman Sachs. I think when they choose to kind of formally step into this arena and offer some sort of cross-margining custody platform that the largest asset managers and hedge funds in the world can tap into, I think, you will see this business look very different than what it does today. But in order for that to happen, we need regulatory clarity, as I know you've had infinite discussions about on your shows. I think the current macro and geopolitical landscape continues to evolve and seemingly in a positive way. So I can only hope that, 2 years down the road or 10 years down the road, things look much different than they do today, but we're still very bullish and excited about the future.
Okay. So I did also want to ask just sort of like about some behind the scenes things, because obviously we have seen, security for crypto assets is obviously something that needs to be paid a lot of attention to. And we have even seen with market makers that sometimes they have had snafus. So what do you think are the best practices there, or what are some of the ways that at least Flowdesk handles it?
Yeah, so, we take security and custody very seriously here, and we're implementing MPC technology to manage that process, both from a funds perspective, but also from a risk management perspective as it relates to exchanges and other venues that, we source liquidity from and we add liquidity to. So I think, going forward, we continue to build out internal tools and utilize as many third-party tools as possible to provide the most efficient, streamlined, secure experience for our customer funds and internal funds, our own balance sheet as well.
And then out of curiosity, earlier you mentioned banking, and I wondered, obviously there was the Operation Choke Point 2.0 that people had seen in the industry where both crypto companies, but even banks that service crypto companies were being cut off, or in the case of the banks, they were being closed. So I was just curious to know how that has affected, your ability to do business.
It's certainly been challenging. It's been a challenging environment. We've been lucky enough to have some very strong banking relationships with some top tier institutions, with an added layer of transparency that goes both ways. We've gotten very comfortable with the way that they manage their risk and do their business. And I think the same could be said about us. Listen, you never know what can happen. And I guess at any point, banking rails can be shut off. We try to mitigate that risk by having multiple banking partners. But, I think things have certainly loosened a bit in the last, call it 6 to 12 months, but they are still challenging to say the least. And we certainly know many of our counterparts that have had a lot more difficulty than we have had as far as their rails are concerned, fiat rails specifically.
All right. So now let's talk just a little bit more generally about the market. I would be interested to hear more of, how business has changed for Flowdesk in the 4 years, especially this last year. It just feels like the market is probably moving to a new phase. Like, how would you describe what the changes have been like?
Yeah, I mean, as I mentioned earlier, obviously the market has experienced some broader tailwinds, I would say, over the last year, certainly from a price perspective. And I think that, today there is quite a bit of positive data points that continue to sort of flow into the marketplace, usually around the regulatory picture, whether that's, tied to the current political landscape or geopolitical landscape, is debatable. But, I think in the past week or two, there's been endless headlines. The state of Michigan added the BTC ETF to its balance sheet. I think Jersey City made an announcement. There was the conference down in Nashville that hosted, some very large political figureheads like Trump and RFK that had incredibly bullish, visionary speeches and addresses. I think Senator Lummis came out and proposed a new strategic reserve. I mean, all of these things I think are lending to a narrative that is certainly optimistic and positive. We see it in our business. We see it in the volumes that we trade, the counterparts and clients that we interact with, and that only continues to scale. So upon joining Flowdesk about a year ago, it became very clear to me that a more sort of strategic OTC offering targeting, this particular clientele made all the sense in the world. And we've luckily been proven right.
Hanson, do you have anything to add on that?
I think just going off of what Reed just mentioned directly is, we've been an LP, a liquidity provider for the Grayscale ETF products since their launch. And so this plays into our ability to be this, what we kind of call sophisticated crypto native firm, where we're working with the Grayscales of the world, as well as some of these other, very specific crypto native projects in our market making business. And so, as a firm, we kind of sit in the middle of the two, spheres, I would say. And that's really how we're positioning ourselves for the next several years to come, as we see the space becoming more and more institutionalized long term.
And what do you feel are still some of the issues or problems or areas of growth for these markets that, you expect to see in the next year or a few years?
I would answer that with one word: fragmentation. I think there is so many different product offerings, so many different ways to utilize your capital in crypto. We're seeing that come up time and time again with new projects launching, which are looking for us as a firm to bring our balance sheet, to use their product, to make markets on their product. We're active on 10 plus different L1s, L2s, ecosystems, trading hundreds of assets on hundreds of different venues. And so there's just so many different things to do in crypto, even for a full-time firm where this is all we do. It can be a bit overwhelming. And so if we are to really get to, I think, a steady state for the industry, winners will win. And unfortunately, that means that some projects will no longer exist in several years. However, I see that liquidity concentrating into the winners that do, and that will ultimately end up with a better user experience for all market participants.
And Reed, do you want to add on that?
No, I think you said it pretty well. The next few months, I think, are going to be very interesting for the space. To piggyback on the ETF narrative, you've seen some of the largest asset managers and hedge funds in the world report, their holdings in these products. And it's been nothing short of pretty amazing at this point. So I think all signs are pointing to broader adoption. And I think you marry that with, added utility and ease of custody and security, and it seems pretty clear to me.
Okay. So obviously we're recording this 3 weeks before it comes out. So I'm going to ask a risky question here, which is because the election obviously is creating a very interesting scenario for crypto, where suddenly it seems to be this sort of belle of the ball, which I don't know if anybody expected, at least when it comes to election politics. And I just wondered, when you look ahead at what might happen, depending on who gets elected. And when I say that, I actually, who knows, because at this point that we're recording, Kamala Harris's presumptive nomination has only been, she's only even been a candidate for like 8 days or something like that. So I truly don't know when this comes out what the state of play will be. But my question for you is, when you look ahead to the various possibilities there, how do you think that change, whatever it is, it's some amorphous but presumably positive change for the crypto industry, how will that affect your business?
So listen, I think that the narrative that's being put forth over the past, couple weeks or months, I think has been overwhelmingly positive. And here at Flowdesk, we are skating to where we think the puck will be in every decision that we make as it relates to our products and what we put forth to the market. Going off of the current administration or historical data points, I think we can all agree on what their posture has been towards crypto in general. Whether or not that changes with her, I don't know. I think there were opportunities to maybe throw their hat in the crypto ring with the Bitcoin conference down in Nashville, and certain candidates, took that opportunity and certain candidates didn't. If that's any sort of, foreshadowing on what's to come, then, you can kind of pull out from that what you will. But, I'm going to operate under the assumption that things will continue to improve, and that, this narrative that's being put forth currently, I think can only be viewed in a positive way.
And Hanson, do you want to add on that?
Yeah, I think just a data point there. We're seeing the emergence of these prediction markets becoming very popular. I think that trend continues to move forward. But most notably, the market is typically a good indicator of sentiment, of where people think the coin will land. And for example, during Trump's speech down in Nashville, as soon as he kind of alluded to his first agenda would be to let go of Gary Gensler, coins like Uniswap immediately rally. And so you start to see traders, I would say, like, investing in an outcome of what they think the market will react to at a future date. And, on the desk, we also see some of those flows as sentiment and narrative changes around, especially the US administration, just given our country's historical importance in the crypto ecosystem globally. Last bear market, we saw many firms leave the US. Flowdesk, we took a different approach. We stuck around and continued to invest and build in the U.S. as we see this market as being, one of, if not the most important sectors geographically for crypto. And so we will operate how we think best we can in any environment and political regime. And I think, to echo Reed's sentiment, we do see things improving every day, regardless of kind of sensationalist headlines coming out of DC with the current administration.
Yeah, actually, because of the fact that you do have offices in Paris, Singapore, London, Toronto, and the US, I was curious. Well, I actually just have to ask you, I don't typically see Paris. I see that like for Ledger maybe, but that's not a super common city that's named in crypto circles. So I was curious about that choice. But just generally also, like, what you see are the differences in terms of your business across the globe.
So the reason for Paris is our CEO and founder, Guillaume Chamon, is a Paris native, as well as some of the other founders. So we do have about 70 employees in Paris. We have about 30 in Singapore, a few in Canada, about 15 in the US as we continue to grow and scale. So, I think geographically, the sentiment remains relatively constant. We're not really seeing anything different as far as narratives go coming out of Paris or Singapore versus the US. I think the beauty of digital assets and crypto is just that it is decentralized and spread out, and we're all rowing the boat in the same direction, so to speak. So I find it to be refreshing that we have a very diverse corporate makeup and geolocation structure. And I think it's helping us, manage the business and put forth, new and exciting products.
And in terms of your clientele, have you seen the launch of the ETFs change the makeup of that significantly?
So I think that the launch of the ETFs have, more generally speaking, put forth a more institutional friendly and accepted narrative. And I think that there are counterparts and clients of ours that we're engaging with or transacting with that might have entered the space upon those approvals. I think that where we focus most here, or at least where most of our, our differentiation or our edge capture lies from a client perspective, is that we can facilitate liquidity way out the risk curve. Some of our competitors do not. They kind of focus on the top 10 or 20 assets or whatnot. We have the ability and the flexibility to trade a wide array of assets. I think by and large, the ETF have enabled some of these larger institutions that were apprehensive to touch the space. They've sort of enabled them, given them the green light to trade Bitcoin and ETH, certainly in the form of a listed, ETP, but, that does trickle down into all corners and facets of the business.
And then I did have to also ask, because miners are some of your clientele, how do you perceive that their business, I guess, has changed given both the launch of the ETFs as well as the halving this year?
Yeah, I think the very direct answer is with the halving, their revenue is cut in half overnight. Top line. So it's a very difficult business, and we saw a lot of shakeup in that industry last cycle. I think partly due to over leveraged, which was definitely a theme across the space. But when you're borrowing dollars against ASICs, and then the terahash per dollar value of those ASICs plummets when Bitcoin mining difficulty goes higher. And Bitcoin price obviously crashes at the same time. It's a very reflexive sort of LTV for that credit structure. This cycle, we're seeing a bit less of that. I think we're seeing the emergence of more and more public miners, so they have access to different types of financing directly with some of these larger like private credit or investment banks here in the U.S., which gives them flexibility of how they manage their business. Additionally, I would say we're seeing more institutionalized hedging and treasury management programs at these public mining companies where they're actually employing, call overriding or buying puts or just general options hedging with their mining production. That could also look like, the emergence of Bitcoin denominated debt, where they borrow Bitcoin, they sell that Bitcoin for dollars today to fund their operations, and they pay off that Bitcoin denominated debt now with their daily rewards going forward. So that industry is always changing. It's always very highly competitive. And so, we have a pretty good pulse on that, just given our conversations and interactions with those clients. And I personally find it a very, fascinating part of the bigger puzzle that is crypto.
So there's another issue that has been flagged recently on crypto Twitter, which is where everything happens, about a difference between the price of tokens on public markets versus private markets for tokens that, are locked up. And I wondered if that, comes into play in your business at all, and, how, and if so, how that does.
So I think we're fairly active in derivatives, and we certainly do facilitate transactions that are more focused on, locked tokens in the form of, forwards. It's certainly a very large market, with vesting schedules coming out of the last bull. A lot of these vesting schedules are quite long, and there are investors that are looking to de-risk or to capture some portion of P&L. They're unable to do that, obviously, in the liquid market. So it requires a more complex structure to realize those gains or to transfer that risk. So it's certainly something that we do and that we're fairly active in today, and we're seeing an uptick in that product as well.
Yeah, the only other thing I would mention kind of along this line is Flowdesk also, we do venture investing ourselves. And so as that part of our business has grown and expanded, we are also, a bit more in tune with these private markets as they're coming to the public markets and the discrepancies in the valuations of both. And so, we utilize those investments on our business, to help founders and protocols, which we can then work with later on in either our OTC or market making business, but also B, to, get that insight into the private markets that we would otherwise not have access to.
All right. Well, then where can people learn more about you and your work?
So you can go to our website, which is flowdesk.co. And we're also on Twitter as well and other social media, LinkedIn, etc.
Okay, great. Well, thank you so much for coming on Unchained.
Thank you.
Thank you.
Thanks so much for joining us today. To learn more about Reed and Hanson and Flowdesk and the strategies around market making and OTC, check out the show notes for this episode. Unchained is produced by me, Laura Shin, with help from Matt Pilchard, Juan Ranovich, Megan Gavis, Pam Majumdar, and Marco Correa. Thanks for listening. Unchained is now a part of the CoinDesk Podcast Network. For the latest in digital assets, check out Markets Daily, 5 days a week, with host Noel Atchison. Follow the CoinDesk Podcast Network for some of the best shows in crypto.